Alrighty guys, welcome back to the best investing money management channel on YouTube. In today's video, we are going to be talking about what on earth is going on with these three companies, Uber, Lyft, and DoorDash. We're going to be talking about why every single one of them is crashing. So I hope you guys enjoy it. If you guys get anything in value out of this, hit that like button, subscribe. If you guys have any questions, let me know down in the comments. And if you want to learn more about investing, money management, trading, we do have a course that offers a whole bunch of fantastic videos, quizzes, lectures, and you'll have access to the group chat, and all of that is for less than a cup of coffee. So make sure you guys click the link down in the description to at least check it out. So starting off, what is going on with all of these companies? So looking here, you'll notice I have Uber stock up here. You'll notice the stock today went from $27 all the way to $22 a share, a 10% crash. And if we pull up Lyft, you'll notice a very, very similar situation where this stock has fallen 12%. And if we go ahead and we pull up DoorDash, ticker symbol Dash, you'll notice very similar situation where the stock went from 47 all the way down to $41. So what is going on with this? So pretty much the Department of Labor proposes to change gig workers. Pretty much what that means is now these subcontract workers like DoorDash, Uber, Lyft, Postmates, all those companies are classifying each of those drivers as subcontractors, so they don't have to pay them benefits, so they don't have W-2, and those workers are technically not employees, so you don't have to worry about insurance and all of that stuff, which makes it more expensive for all these companies like Uber, DoorDash, Lyft, all of those. So the Department of Labor wants to change or plans on changing those workers to something called gig workers. So it's a really cool concept. It was imposed by Biden, the Department of Labor. So anytime you have an article like this come out, this will cause pretty much a whole bunch of panic in all of these companies like Uber, Lyft, DoorDash, all of those, because now it's going to be more expensive for these companies to become profitable. And anytime that a lot of investors kind of say, okay, I want to take a step back, sell my shares and reevaluate. And that's kind of what we saw. We saw all these stocks start selling off. And the thing about it is if we look at every single one of these stocks, like DoorDash has gone from a stock that was once $257 all the way down to $41. So this stock has been getting obliterated over the past year. If we go ahead and we look at Uber, very similar situation, from $64 all the way to $24. And if we go ahead and we look at Lyft, you'll notice a very similar situation. The stock from $68 all the way down to about $11 a share. So that's kind of what's going on with them. And answering that main question that a lot of people have of should you invest during these times, I definitely think the best thing to do, especially for beginners, is to just take a step back, right? Right now, with all these stocks that we're kind of talking about, sellers are in control, right? We have these just downward trends, and anytime you have a downward trend, sellers are in control, and especially during a time right now of uncertainty, right? Where interest rates are high, where inflation's high, where pretty much just people aren't spending like they used to. I definitely think we'll see some sort of crash with all of these stocks. And I'm very, very confident with that because I believe in the next couple of earnings, we'll slowly start seeing, okay, all the stimulus money that, when everybody was getting a $1,400 check, it's a lot easier to order DoorDash. It's a lot easier to have somebody bring the food to you, or you can take the 10 minutes, and go out and get your food. But now I definitely think we'll see a crash in all these stocks because it's more expensive to become profitable because of the change of workers, and just people aren't spending like they used to. So for me, I'm definitely just going to take a step back. I'm not going to invest during these times. If you were going to invest, I would dollar cost average it. The reason why is because it's a lot easier to make money in the long run when you dollar cost average, especially with these high volatile, high growth stocks that continue to go up and down at very, very, very rapid rates. So dollar cost averaging is just a way to invest on a weekly basis. That's pretty much what you do. You set a fixed amount of $10, $100, whatever you want to invest, and you invest into a stock. So the beauty of it is as the stock, sells off, you're averaging down those shares. So once the stock recovers, your average cost is so low that when the stock recovers, you make a lot more money compared to just doing a one lump sum investment. You could be investing at, some highs and the stock could continue to sell off more. So that's kind of what's going on with these companies. I'm super excited to kind of see what happens with this. I think this could be a game changer for the workers and the companies. So that's what's going on. Hope you guys enjoyed it. If you did, hit that like button, subscribe. If you have any questions, let me know down in the comments, and we'll see you guys later. Take care.